This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
Welcome back. Another episode of Real Estate Investing 365. Today I got with me Kevin Wood. He's from Houston, Texas. He got started in real estate just back in 2015, and he's the founder of Stagecoach Equity. I think right now they got about 112 doors and even more under management. So what's up, Kevin? Thanks for being here.
Yeah, man. How's it going?
It's going great. It's just trying to fight the coronavirus. We were just talking about that offline. Make sure nobody gets it. Whether you think it's a big deal or not, financially, it's becoming a big deal, I guess.
Yeah, hopefully in 10 years, people will be like, what's that? What was that? You know?
Yeah, for sure. Well, it's all, Corona, I guess, is the family of viruses, right? It's like COVID-19 is the actual virus, but there's like so much more to it than, I think there's skeptics out there and there's people that are overblowing it, but somewhere in the middle, I think it's kind of semi-serious. So about to find out either way.
Buy one package of toilet paper, not 6.
Yeah. My friend posted something. She was at Costco and she saw a guy in line and he had, just like 2 packages of toilet paper, not big ones, just like the smaller ones. And she's like, she wrote a thing about it. And I wrote her back and I said, maybe that guy was just on his way home from work and his wife was like, hey, honey, we need toilet paper. And now everybody's posting pictures about him being that guy. And he's like, I just needed toilet paper. So who knows? Anyways, besides that, so why don't we dive into kind of your background and what you did before real estate and how you got started in real estate, you got the idea, and then we'll move forward to your current company and what you do now.
Yeah, I got out of college in 2007. I was from Houston originally and decided to go into kind of the CPA world. So Enron and all that kind of stuff had just happened. And with that came a lot of job opportunities, and particularly like the audit space, because the government kind of cracked down for a little while on what was required. And so fell into that a little bit and started out at KPMG, one of the big 4 firms, was there for, I think I was there for about 3 years. And then I had done an internship there as well. So 4 years total. And when I did that, realized that it wasn't something that I wanted to do for a career because it's very linear growth and there's not a lot of variance, so it's hard to perform well in that sense. Mm-hmm. And so I started looking at small businesses. It was something I was interested in. I was reading a ton of books in my 20s on small business, on decision making, things like that, just kind of, scratching that curiosity. And went to work for an oil and gas services company in Houston. And that was in 2010. And then when I started there, I think their first year, the year before I got there, I think they had done about $2 to $3 million in revenue. Within a year, we would be doing 17 million. And then the next year we would be doing 30 million in revenue. Jeez. And so through that, we had become one of Inc. magazine's fastest growing companies in the US. And randomly one day, I got an email from someone on LinkedIn saying, hey, would you like to come work for Google? And I was like, I thought it was fake because I had read, I had kind of saw Google from a distance in college and read about how, many applications they get per day and all that kind of stuff. And so I kind of didn't respond or was like joking with them. And they're like, no, this is serious. And so I went out there, ended up getting a job. I first said no. I was like, no, I want to stay in, family and friends. And like, but then I kind of couldn't go to sleep about it. And I was like, man, I really am going to regret it if I don't at least try this out and see what it's like. And so in 2012, I went out there and started with Google in the finance group, and then would eventually move to the engineering side and product management, which essentially means working with engineers to kind of develop software. And during that period, so I started in 2012, around 2015, a friend kind of had told me about real estate in 2014, 2015. And so I started actually looking into it, and um, ended up buying my first five houses was my first deal. And these houses, most of them were between, I want to say between like 40 to like 80,000 type price range.
Mm-hmm.
Um, had really good rent to price ratios. It was like 1.3 rent to price.
Where were those at?
Those were in Channelview, so just east of downtown Houston, about 5-6 miles.
So you're still working in California for
I
Google?
am, yeah,
Okay.
yeah, and bought those. We're managing them kind of remotely, and then, like a lot of people in real estate, was listening to all the Bigger Pockets podcast, and people started talking about, multifamilies, and I couldn't buy a whole apartment complex by myself, and I didn't have any experience, so I wasn't able to raise money at that point. And so I found something that was basically a tear down. That was a 14 unit. Offered on that, ended up getting it under contract, and I had been home from Google like during this acquisition, and was just working on the property constantly, to try to get it up and running. And ended up, long story short, kind of turning that around. Picked a really good location. It was in North Houston and Independence Heights, in 2015. So that area is significantly gentrified. Added A-class grocery stores, tons of restaurants, tons of development, um, and shortly after that, I got my first 6 unit in the Heights, and I had negotiated that deal for like 13 months. Um,
Jeez.
and then, yeah, I ended up getting it 250,000 off asking price, which is pretty good, because it was at like 850, and I think I closed on it at like 500 or 550 or something like that. Um, so yeah, I mean that's kind of how I got started, and then after that, experimented a little bit with wholesaling, bought some houses, tried that out, and then also, just started focusing more and more on multifamily as Google coworkers, as well as other folks through the Bigger Pockets network, started asking to invest with me.
Yeah. Okay. For sure. So one question about the accounting: when you're working for an accounting firm like that big accounting firm, what do you do all day? Is it literally just like when we do our own accounting, you just get on the computer and you just like running numbers all day long?
Yeah. Well, so the way it works, the idea behind it is that you have financial statements where companies are reporting their earnings into the stock market. And as you can imagine, if you have better earnings, your price goes up. If you have worse earnings, your price goes down. And so what accountants do is they try to assess the most risky areas within a balance sheet or an income statement, and then they'll perform audit practices. So as an example, if someone's like, I made 5 million in revenue, we'll say, okay, where are the contracts, where are the receipts of funds, all of that sort of stuff, to just try and verify that the data that's being presented to the SEC is correct. And so
Mhm.
that's primarily what auditors do, particularly the big four companies. Pretty much audit all major companies within the stock markets, because that name kind of has some meaning, and it's respected, I guess.
Okay. Yeah, I was just kind of curious. Never really know what those big auditing companies do, I guess, because I'm not in big business. So,
Yeah.
someday maybe I'll figure it out. Okay. So you end up buying your first 5 deals or 5 properties in one purchase, right? It was one
Mm.
like portfolio purchase in Houston area.
Yeah, and I it was 8 properties total,
Okay.
and you know what I ended up doing is getting him to kind of, I negotiate we negotiated on price really hard for a long time, and then we got him down to this final price, and I asked him to break that price up into properties, and then I took the ones that had the best rent to price ratio out of the 8, so I bought 5 of the 8 and then left the other 3. um, and so it was a long negotiation, but ended up making us a pretty good return. We put in, I think, total down like 60, 70,000, and then within a year we pulled out 50,000 or 55,000 in profit when we sold those.
Okay, cool. So was that just you, or you bought it with a partner, another?
It was my friend that was getting started. Like he he was working with me kind of early on
Mm-hmm.
to get our portfolio. I was always the guy finding the deals, negotiating the deals, raising the money and things like that. And then he would kind of be my on the ground type guy that would go in and make sure things are getting done and stuff like that, because I was in California, so I couldn't be in Houston all the time. But
Okay.
now I'm just kind of on my own, doing my own thing,
Yeah.
focused on apartments, and he's kind of started a whole nother career outside of real estate investing.
All right. So how'd you guys end up finding these properties? Was it just I mean, at that time in 2015, I
Mhm.
guess, hindsight, it was still an awesome market, whether people at that time thought it was or not. But
Yeah.
how did you end up finding them? Was it on market, off market?
So it was um, this deal was off market a little bit because we had found an investor that, for him to individually list every unit, he would have had to gone to 8 different closings. And so there was a benefit to him to just packaging it all up. And he was also looking to close a little faster with people that he knew could buy.
Mm-hmm.
Um, and so that's kind of how we found that one. But on
How'd
the
you
small,
actually how'd you actually find him? Like,
he was a friend of a friend. Like there was a older guy um, that we knew, and he had been kind of doing these. He was doing owner financing loans, and so this was a acquaintance of his,
mm-hmm.
and so he reached out to us and was like, "Hey, I know you guys are interested in potentially getting started in real estate. Like, here's some houses I'm trying to sell. Let's go and take a look at them." Type deal.
Okay, so pretty much comes down to that, like they always say, like especially on bigger pockets, they say like talk about it, tell people that you're into it, network
Yeah,
with
yeah,
people, say, hey, I'm looking for these deals, and don't be embarrassed to tell people that you're in real estate or getting into real estate, because you never know, some guy like this will come along and say, oh, well, I have these properties I'm trying to offload. So that ended
yeah,
up
yeah.
happening that way, which was pretty cool. What do you think those properties in that area in Houston are worth now?
Um, Yeah, I mean, I'd say rent to price ratios have dipped down probably to about 1%. Um, I think
Can you
had we held on to them, they'd be worth another, like, I don't know, let's say like 40, 50,000.
mhm.
Um, and I think that's important for anyone, is like, I know you can get wealthy in any area of real estate, and it's about what are your skill sets and how do you best fit into the different investment properties. And so for me, apartment investing became something that was more to my skill set
Yeah.
than buying single family homes.
Okay, so real quick before we move on to that, can you explain, if somebody doesn't know, what rent to price ratio exactly is and how you like determine it? Like, how would you pick it in an area that you don't really know?
Yeah. So the rent to price ratio is just what the unit is renting for, or will rent for, and dividing that into the price. So back in 2009, 2010, people called it the 2% rule because some people were getting 2% deals. Um, but for Houston, it was around. Like I said, I think we bought it like 1.3, which was a really good deal.
Mhm.
And now, so that means if it's renting for $1,000, and then I just divide that, then that house is purchased for $76,000. 1% would be $100,000 at $1,000 a month rent. It's just a real quick back of the napkin way of seeing, what the returns are on the property.
Mhm.
And I still do that with apartments today, to where I have an analysis funnel. So you quickly look at a lot of deals, right? Because you want to look at everything. Um, you quickly then, if the ones that look good, you then take those and you do a bit deeper analysis, then filter again to do a bit deeper analysis, all those sorts of things. So hold on, let
Yeah.
me shut this door real quick.
Yeah, go ahead. Yeah, so the price to rent ratio is just mainly an easy way, like you were saying, to be able to determine whether a deal is
Sorry,
something you really want to
I've
get
got
into.
a 4 and 5-year-old, so
Oh, I
That's
know.
why.
Yeah.
That's why the office is moved to the closet because they like having a good time. So.
Oh yeah, no problem. I got 3 kids too, little turds running around, causing havoc. We're trying to sell our house right now, and because we're moving out of state, and it's just like a nightmare trying to have people come over and look at it with 3 kids running around, and they do pretty good, but at the same time, it's like you want it to be perfect, and they got crap everywhere. So I know what you mean for sure. Okay, so yeah, no, the rent to price ratio definitely makes sense. I just wanted to touch on that for some people, and if they are moving to, or if they're investing in an area they don't really know, a way I think that they can kind of determine that is look at, you just got to look at a bunch of single family houses if that's what you're into, and then rentometer maybe, and then just get an overall idea of what a 3-bedroom house is going to rent for in the area, and you can kind of guess, right? Is that what you would do in a new area, or is there places?
Yeah, and I mean, for any new area too, I would spend, at least several weeks looking at every single deal. So like for Channel View, I just set up an alert that was like in these neighborhoods in this area, I want you to send me every single 3-bed, 2-bath house.
Mm-hmm.
And then, you just need to buy a good deal for that area. Um, assuming you want to make long-term money. In the short term, you want to find stuff that cash flows. But like if I'm in San Francisco and I buy something that's 20% below market, what everyone else is buying for, that's a good deal, regardless of what the rent to price ratio is, right? Just like in Channel View, I was paying less than a lot of people were paying in that marketplace.
Mm-hmm.
And so, I think that's a big thing to look at, is see what other properties are doing and how they're performing. Because if a property, again, if you get a 20% discount, worst case scenario, I can always sell it and get that 20% bump because that's what the market's paying.
Mm-hmm.
Um, and so that's how I think about it. Is I was buying for cash flow early on, so I would find middle class, lower middle class areas with strong rental bases, and then typically those are going to give you a bit higher returns. Most of the properties we would buy are in the 1960 to 1980 construction
Yeah, for sure.
range.
And if somebody's getting started in that, maybe doing the same thing, pretty much being a wholesaler, except keeping the properties. If you got the money and you want to do that, well, then go out and do the same marketing that like wholesalers or these bigger acquisition companies are doing, because they're getting the properties at a discount through direct mail and all that different sort of things.
Mm.
So just end up keeping the property. Don't just flip it to the next guy and keep that profit, is a kind of the way to get ahead. So,
Yeah, for sure. And I think it, if you really want to generate wealth, you have to hold on to assets, and those assets need to give you a return.
mm-hmm.
Um, almost everyone I know that has done wholesaling for a very long time, they either massively scaled their company and just completely all in on wholesaling, or they started as they earn money switching into other investment vehicles because that's going to generate more wealth for you over the long term.
Yeah, for sure. Like for what we do in Boise, or what we're trying to do, it's not going too great. But every 4 weeks we're buying a house up there, and but we originally, our plan was to wholesale, but since we have the money, and we don't wholesale anything really. We're either
Mhm.
wholetailing it, buying it and then put it back on the market if it's not a good rental, or we're buying and holding. So uh, definitely the long term goal is to hold as many as we can, and small apartment complexes, whatever we end up coming across. So that's kind of where you went next. Was you went to the 14 and then the 6 unit. Um, pick one of those, and we'll dive into which one of those is kind of like a good teaching point for the audience.
Um, well, I guess the 14 unit we bought was in a worse neighborhood than the 6 unit. There was drug dealer living there. There was like convicts, ex-convicts living there, all kinds of stuff. Like people were paying week to week. It was being run as essentially, it was a shotgun apartment, which is just a 2-story back building and then 2 houses in the front. And it was chopped up crazy. Like there was um, plumbing coming out of the walls. Like they didn't hide anything behind the walls, like sewage issues, just like a complete disaster zone. And, you know, we were kind of ignorant at the time in that, you know, I thought it was going to cost, say, $80,000 to repair, and it ended up long term costing us like 180,000.
Yeah.
Um, but the thing is even if you're just getting started, as long as you follow good purchasing principles, like, you're going to be fine.
Hmm.
And so, you know, I think all in, we probably have, I don't know, maybe like less than 100,000 in the property because we pulled cash out with the refi. Maybe a little more, but it's worth, you know, probably about 1.3, 1.4 million. And we, you know, after we pay our loan down, that would be a pretty substantial profit, like
Yeah.
double digit returns on our money.
So you still have that property today?
I still do, yeah.
Okay.
It's a bunch of studios, and we rehabbed them, made them look nice, and so I just manage them now.
So you bought that property in 2016 or 17?
15
Oh,
October of
yeah.
2015.
So you bought your first 5 single families in 15 also. So you kind of just
Correct.
like you just jumped all in. You just went in full bore.
Yeah, I mean, that's kind of how I am. Like, I do a lot of analysis on the front end, and then once I pull the trigger, then, you know, I'm kind of off to the races on it.
Yeah.
Um, and you know, after that, we got the 6 unit, which was in the Heights, which is a really nice rental market, and even at the time, it was. And that one needed less rehab and higher quality tenants. And we've rehabbed that now, but we run some Airbnbs out of it and things like that. We run about 12 short-term rentals across all of our properties.
Okay. So on the 14 unit, since it was such a remodel and such a kind of disaster when you guys took it over,
Mm.
two things: how'd you find it, and then what type of loan did you get for that property? Because it's probably a different type of loan than for the 6 unit.
Yeah, um, so actually both of them we had to use community banks. So Fannie Mae, they do almost all of the home loans that people use for single family homes.
Hmm.
They also do all large property financing as well. And so there's this space basically for 5 units and above, there's this space of sub $1 million loans that are handled by the local community banks. And so what I did is I went to a bunch of banks. It's really hard to get your first deal financed because you don't have a track record.
Yeah.
And so just kept going around, found the bank that was going to give us the best terms. And you know, they thought it was a high risk deal and that we were high risk, so they wouldn't fund any of the rehab. And so we were kind of on the hook for that. And as you can imagine, if you think something's going to cost 80,000 and it's 180,000, like, you run out of money, which is part of the reason we sold those 5 houses, was because we were like, if we put this money from these houses into this 14 unit, it's going to pay more dividends for us.
Hmm.
Um, and so, you know, that's kind of our thought process behind there.
Okay, so did you actually physically like go into all the banks and talk to them, or did you just give them a phone
Yeah.
call and kind of give them an overview? How did that go down? If somebody
Um,
was looking to find a bank to work with, how would they do it?
yeah, I called a lot of banks, and then I went into a bunch of banks too. But the way you find it out is you just go on, you know, your Bigger Pockets forum or wherever, find someone who's investing in that product and say, hey, what banks do you use?
Hmm.
And so I did that on Bigger Pockets. A lot of people suggested a bunch of different banks. I called all of them, and, you know, ended up finding someone that was kind of, you know, willing to take a flyer on us.
Yeah. Okay. So you guys ended up getting into it, and then the repairs ended up being kind of more than you anticipated. Now, did you kick out a lot of the tenants, or was there just like so much turnover that you didn't really have to worry about like evicting people?
The thing is, you know, when you have a tenant and you start enforcing your lease or your rules, um, typically the bad actors are going to leave because they're like, okay, this isn't joking around anymore
Yeah.
type deal. So we just started implementing a $5 a day late fee, which is like super low. To give some context, we charge today, like in all of our units, 75, and then 25 a day after that. So, like, to charge $5 a day is nothing. But as soon as we did that, I think we had 3 people leave within a week, just because they saw that, like, okay, this owner's different. They're trying to take care of the property, and I'm not wanting to follow the rules, that sort of stuff.
Hmm.
Um, and and yeah, it was a super super nasty place. And as we started rehabbing units, um, it becomes tough when you're kind of in between, because new tenants that you want in your unit are not willing to live next to people that are, you know,
Yeah.
not great. Um, and so it is tough making that transition if you are doing it piecemeal, which we were doing. But once you complete that work, then it's really easy that second wave of tenants come in, and then it completely changes over the complex. So we kept a couple good tenants from the previous tenant base, and then that first wave had some turnover, okay tenants, and then it's like that next rerun is when it becomes a lot easier.
Okay. Did you guys do all the work yourselves, or did you hire contractors, or?
Yeah, we hired contractors at first, and a contractor we hired basically ran off with like $6,000, and the guy he had working on our unit was buying drugs from the drug dealer in our complex. So we like got rid of the drug dealer and the contractor, and
That guy thought he
started.
hit. That guy thought he hit the lotto. He's like, man, I can go to work and get my drugs at the same place.
Yeah,
This is
exactly.
awesome.
Yeah, and so that was definitely trying, and so what we did is just, again, relying on other investors, like, hey, who do you know that can do plumbing? Who do you know that can do uh, electrical, all that type stuff? And we just started adding people to our repertoire. And there was a while, and again, this kind of goes back to when you're new, you're experimenting with a lot of different things, seeing where you fit. There was a while where I was doing like general contracting as well for other investors, because we had developed a skill set around it. But now that's not something that I do myself personally. But my old friend, he now does exclusively contracting, and doesn't do really much real estate investing.
Okay, cool. And then you guys so you turned the property around. Did you end up refinancing it with the same bank, or did you guys go out and did you get a like more agency or Fannie Mae or Freddie Mac loan, or what? How'd that look? The refinance.
Yeah, so the refinance didn't happen until 2019, and
Okay.
the reason for that is we were doing all the units as we could type deal,
Hmm.
and we also acquired units with investors, and so we prioritized those units over ours. So we were cash flowing, 16, 17, 18, and then also we'd be rehabbing like 1 or 2 units at a time type deal. Um, and when we refinanced, we had a track record at that point. And so um, once you've done, say, 2, 3 deals and they're going well, then it's really easy to find bank support after that. And so, bankers started calling us in some cases. And also, there was a lot of banks that, wanted us to move into their bank. And so we were able to kind of find the best deal for us and refinance.
Okay, cool. Well, no, that makes total sense. So you kind of moved from there. It was just you and your partner. You had bought these single families, the small apartment complexes, and then you wanted to move up into bigger things, I assume, right? So,
Mm.
what was that transition like getting into other apartments? You probably needed to bring on some investors or something like that. Like, how did that work?
Yeah, I mean, after I bought my 4 and 6 unit, I was pretty, all in on real estate at that point, and started to need additional capital. And so the first thing we tried was wholesaling. And wholesaling, it's a good business, but it's very time intensive, as I'm sure you're aware. And so, and also it's an in-person business. So I was able to do well, but it just, like, when I factored in my time and I was also working a demanding job, it became very difficult to scale it.
Hmm.
Um, so we did that for about 3, 4 months, but we ended up acquiring 4 properties from that, um, including or no, sorry, 5 properties from that. And 3 of them, we brought in our first investor, who was someone I worked with at Google, who still is an investor of mine today. But, um, you know, people in California wanted access to better deals, and I knew the Houston market really well. And so just in chatting with people, they would tell me they were interested, and I would bring them in. Um, and so I bought some single families with an investor, and I was like, oh, hey, this works pretty good. Like, let's start looking for small multifamilies again and buy those with investors as well. Um, and so, yeah, started looking all of our small multifamilies for, I think our first like 4 or 5 were all from the MLS. Um, it's not an it's an underserved market, both from a broker standpoint as well as a investor standpoint, because it's more money than most individuals can pay,
Mhm.
but it's too small to syndicate, and so there's typically less competition, in my experience, in that asset class.
In the what, the small, like
Small
what,
multifamily, yeah, like
like
basically
5
stuff
to.
from like 5 to 30 unit type range.
Mhm. Okay. And what you just said there was a kind of a good point that I want to hit on is that, so for one, it seems like everybody is doing syndications now, right?
Yeah,
But what people, if people want to get into that space, I think if you haven't got there, you kind of feel like you have to just go from your small deals right to these giant deals, like,
yeah,
and you got to make that jump right away and like do all this legal work and get your whole 506 B or C or whatever you're going to end up
yeah,
having. I don't think it's necessarily that case, right? Just like you said, what happened is you were doing these small deals on your own, you were making stuff happen, and then you knew somebody at work that wanted to come in, you joined with them and they invested with you, and then you got more investors, and it's kind of just like a slow uphill snowball. It's like getting bigger and bigger or whatever, to where eventually now you're at where you're at and you can raise more money and bring in more investors. But it was not so hard that it was just going from, oh, I'm buying a fourplex to now I'm going to buy a 100 unit complex. Like you don't have to do that giant jump. You can take small steps,
mm,
right?
yeah, exactly. And I started, I kind of was doing it on my own. My background's accounting and finance, and so I started modeling out different investment scenarios, where we weren't putting in any money. And I fell on a model that I still use today, which is different than everyone else in that, um, if I had contributed capital, then I would give myself credit for that. But if I put in $0 and the investors put in $100,000, until the equity matched up, so let's say I take 40% of the deal, until I've either contributed 40% or I've paid them down $100,000, then I didn't take any money out of the deals. And when I mapped it out that way, you end up making a lot more on the back end, assuming your deals perform. And so I was able to capture a lot of equity from those deals. And it was good for investors too, because I was giving their money back faster than they would see in a normal syndication.
So what you're saying is that you would take like a bigger percent, you would own as like let's say the general partner, the guy that finds the property, you would own a bigger percentage of the property, but you say, hey, you know, I'm going to have a bigger equity in the property, but I'm going to pay you back all your money first before I take any draws, is what you're saying.
Correct, yeah. And we would charge an acquisition fee and like property management and stuff like that, because we would self manage.
Hmm.
So we had a little bit of income coming in, but in terms of long term wealth, I knew I wanted to own as much of the assets as possible.
Hmm.
And so I would backload as much equity into the deal as I could, in order to, again, generate that long term wealth.
Okay, cool. So how did you go out and find these deals? You mentioned that like your first several were on the MLS,
Mhm.
but like, today in today's market environment and where everything's at, how are you finding the deals now? Is it through brokers because you have a track record, or what are you doing?
Yeah. Well, now I'm using brokers because I'm buying things that are over, um, $1.5 million. So we target purchases. Right now, I'm looking for something in an apartment complex in like the $4 to $10 million range,
Hmm.
which is kind of, any time you're looking at that product, it's typically going to be brokers. And in order to get into that that marketplace, you kind of have to pay a little more or go through a little bit more hoops, because the brokers are really cognizant about eliminating people that can't close the deal.
Mm-hmm.
And then once you actually close the deal and people realize that, hey, they closed the deal, like they're good, then it's easier to get deals. Um, and I think on the small stuff, I mean, the number one mistake I see new people making is they don't make offers. Like that's literally by far the number one mistake.
Yeah.
And Brandon Turner even has talked about it a couple times as well, is like, how many offers did you make? 99% of people say zero, because
Right.
they're like, oh yeah, it was just priced too high. I got $250,000 off apartment complex and ended up making 500-600 grand on that deal, in terms of what it's worth today, all because I just made a super low offer and I was the only one who offered because it was overpriced.
Mm-hmm.
And so, I think in terms of like finding deals, I think deals still exist on the MLS. I would guess that 90% of people who say they can't find deals aren't making offers.
So in MLS, so you're talking about like maybe let's talk about the deals because 5 to 30 units, what you're talking about, kind of that middle ground of deals. These aren't real big brokers and aren't residential agents. What type of MLS are you talking about? The regular residential MLS or
Yes.
just on LoopNet or
So on the Houston MLS, you can list anything up to 12 doors.
okay.
And what'll happen is, like, let's say I have a 16 unit. I can't really find someone that'll broker it that has experience. So I just find a real estate agent, and then that agent will list it as a 12 unit on the MLS. So the 14 unit we bought was listed as a 12 unit, and people offered on it based on it being a 12 unit. But when I called the broker and chatted with them, they're like, yeah, there's actually 14 units here. It's in real rough shape, but you have more to work with. Um, and yeah, like I said, it was a real estate agent. So I would just like constantly call these real estate agents, see if any offers had come in. Typically, you're going to buy something within the first 24 hours of it being on the MLS because it's a really good deal, or it's going to be, say, 45 days later where they haven't been able to sell at their price and they start having some urgency around getting that money because they're moving, retiring, whatever.
Mm-hmm.
Um, and in that one case, it took 13 months to get that deal. It's just about follow up, and I'll have a spreadsheet with all the deals that I'm looking at, and then it's just constantly calling and checking in on those deals.
Okay, so in Houston area, what happens to the properties that are over like far like a 25 unit property or 26 unit property? Like what is
Yeah.
that where does that go to be listed just like on LoopNet or
So
what do you
there's some broker groups that handle that small multifamily stuff. So we have about 3 or 4 uh, shops that sell that smaller product.
Mhm.
And the way I found out who those people were is I found people that owned other small multis and was like, hey, who do you work with? you know,
Yeah.
um, and most people are gonna give you the brokers that they work with for those deals, and you can also Google search as well, or ask on the Bigger Pockets blog. And it another thing you can do as well is check out LoopNet has a lot of the small stuff as well. um, Typically on LoopNet you're not going to find great on LoopNet, you're not going to find great deals, but you'll find great relationships. So you can see who the brokers are that are listing the product you want to buy. Give them a call and say, hey, I'm not interested in buying this one. It's priced a little higher than I want, but I'm looking for stuff in these areas at these prices per door. Once you get into the bigger stuff, it's really comes down to price per door. Let me know if anything comes up, and
Mhm.
that's a great way of finding those brokers as well as through LoopNet.
Okay, so what are some of the ways that you can contact a broker if you're newer and kind of get him to take you seriously? Because that's kind of an issue a lot of people seem to have.
I mean, I think if you're trying, because I wasn't successful at this. I think if you're trying to talk to someone that's selling deals, say north of 3-4 million,
Hmm.
um, it's going to be real hard for them to take you seriously without any experience. Um, and so I think it's going to be tough. But I think for the smaller stuff, there's just not a lot of there's just not a lot of people in that marketplace, because again, it's too small for a lot of people and too big for a lot of people. And so it's much easier to buy something, say, under $2 million, and to take it seriously when you put in your offers. Like, one thing you can do is offer a really high earnest money deposit. So you can say, hey, I'm offering an earnest money deposit on this $2 million deal of $75,000. Well, they know you're pretty serious if on day one you're going to put $75,000 into escrow.
Mm-hmm.
Um, and that amount's still refundable, but it at least just shows like, hey, I actually have buying power with me and can close on this thing.
Right. No, yeah, that definitely makes sense for sure. So there's tons of questions. Obviously, we could dive into all kinds of details on this thing, but what about property management? Do you guys manage your own properties?
Yeah.
At this point, you have like 112 doors, I believe, right?
Yeah. I have 112 that I own, and then we manage about 160 or so.
Okay.
Um, and we're adding another 75 unit to our management portfolio as we speak. But Stagecoach right now, we focus on syndication deals, buying larger apartment complexes and managing small and large multifamily. So we don't manage any new single family homes. We have some still in our portfolio, from my past investing, but um, that's our primary focus now, is within 2 hours of Houston, up to 250 doors for management or purchase. And that's kind of our sweet spot right now.
So you ended up starting a management company along the way. Why did you end up doing that? A lot of people think it's, a bad idea or whatever. So what was your thoughts?
Yeah, I mean, I think for me personally, single family, I think no one needs a management company for. I was managing, for the most part, 9 houses from California,
Mm-hmm.
doing it all online through Buildium, and it wasn't a problem. Like, I could manage the properties because someone's going to be there for a year. Once you start getting to apartments, you do need someone on the ground that's managing it. And so we looked at other property managers, and again, similar to the buying side, there wasn't a lot of people that were in that marketplace, and then the ones that weren't doing very well. And if I'm buying a deal and I see their property manager, their financials, I see how much their property manager's charging and the fees and stuff, and it's hard to support, say, staff on a 10 unit, right?
Mm-hmm.
And so property management doesn't make a ton of money until it hits scale. And so you would not get high quality people because they're not going to make money on a 6 unit. And so it was out of necessity of needing someone on the ground. And so we ended up hiring someone that worked with us for about a year and a half, uh, that after he got out of work, he would do showings on the weekends and showings in the evenings, and helped us get going on managing our own stuff, and then started just slowly developing systems, trying to get a little bit better every week, which is, all business is just trying to get a little better every week.
Mm-hmm. Okay, cool. So in the Houston market where you guys are at, what kind of do you have a set number, like return, like cap rate that you look for, or cash flow per door, or a percentage? Like, what's kind of your basic overall numbers that you're shooting for when you're buying, let's say, a 20 unit building?
Yeah, I mean, I think you're always going to look at your rent to price per door.
Mm-hmm.
So the way once you start getting really, say, 20 units and above, it starts becoming a price per door thing. And so they're like, oh, I'll pay 40,000 per door in this area type deal. And the
Mm-hmm.
way people calculate that and calculate the cap rates is they'll look at what the rents are, and then they'll look at data around schools, demographics, jobs in the area, that sort of thing, and try to develop a sense of what things will be priced. And then you're also looking a lot at the value add. So the smaller the deal, the more value add that we need on it to make our money, because if I have investors coming into a deal and I want to take more at the back end, if I'm buying something and just leaving it as is, there's not really a lot of value add for the investors, and so it doesn't make a lot of sense for them. Uh, so on the small stuff, I want significant value add where I know if I rehab the units, they're going to return, say, anywhere from 1.5 to 2 times the rent that they're renting for right now.
Okay, cool. So that makes sense. I really like the more you say that, I really like that idea of like taking a bigger part of the equity but paying them back quickly, because I mean that's what a lot of people, they want their money back, so they can do other stuff with it or whatever, especially at this level of apartment deals. They're not putting in $1 million and they don't have $10 million sitting there. So, giving you 100 grand to work with is probably like a big chunk of their money. So I do like
Yeah,
that. Uh,
I think the syndication model that is used today was predicated on the stock market and hedge funds,
mhm.
because hedge funds have what's called a 2 and 20, which bled over into real estate, which is like um, the manager gets 2% of whatever they raise, and then they get 20% of the returns. And if you think about a hedge fund, they can't necessarily return capital because they're trying to constantly get leverage and allocate capital. So they're not able to necessarily give it back. Real estate's completely different. There's going to be a refinance event or an improvement that's going to cash flow the property and give you additional income to then allocate into other investments. And so by its nature, it's more susceptible to returns than say the stock market. And so again, I wanted long-term wealth, and so focused on you know completely rewriting that model.
Yeah, for sure. No, that makes sense. So where are you guys headed from now? I know you said you're looking at like the $4 million range of apartments, 4 to 10
Yeah.
million. So what's like the plans? Because are you still able to find those deals now in Houston, or you
hmm
looking at other markets? What's your guys' future growth plan?
yeah, so um, we're just now starting to really grow our property management side. We've developed some really strong systems that apply to larger complexes. Um, to give an example, the $4 million property I bought in June, no one wanted it. It was 70% occupied in a good location, but just a terrible tenant base. I now have that at 90% full, and the average rent has has probably gone up about 100 bucks a month or so,
Oh, sweet.
because we got rid of some low paying tenants and some non paying tenants. And it's still in the process of completely turning over, but we have a lot higher quality tenants and are cash flowing that property a lot more than it was. And it went from a place no one would touch to now it's like one of the best managed properties in the area.
Okay, cool. No, that makes a lot of sense. So, I guess part of your benefit is that you really know the area, right? And so you're not
Yeah.
like you're not still in Sunnyvale or in the Bay Area in California and going out to Houston and trying to just like have an overview, but you're from Houston, you know the area really well. So
Mm.
do you think it's more of a benefit to invest in your own market or out of state? Like, what do you prefer?
Yeah, I mean, I think it kind of depends on what you want to do. So if you're a guy that's like, hey, I like what I do for my full-time job, or I have a family, this is just an investment vehicle for me,
Hmm.
then that type of person's going to want to buy single family homes if they're willing to do a little bit of work, or they're going to want to invest, with other investors like myself or whoever into their deals because they don't want to do any of the work. So that's kind of one bucket. If you're a person that's like, I want to make a career out of real estate and I'm really good with data and numbers, then you're going to be and also really good at raising money, which is kind of like my two skill sets. Then you're going to want to be in the apartment space because that's very data driven. You're competing with, more sophisticated buyers, and the sellers are more sophisticated as well. It's very rare for, say anything over $3 million to have someone in serious financial distress that's selling out of urgency, right?
Hmm.
Um, and then wholesaling's for someone that's like, I don't have a lot of money but I have a lot of time, and I'm willing to get on the phone and make 250 calls a week in order to make some cash so I can buy some properties and hopefully get some seller financing deals set up. So that's a whole different bucket. Like that's the wholesaling bucket. And then um, real estate agents, in my opinion, isn't necessarily like an investment vehicle. I have one for my property management business. And I guess the other one that I would talk about is property managers. And what property managers, it's a very systems driven business. It's also very customer facing. So you need to have good customer service. People need to enjoy interacting with you.
Mm-hmm.
And so that's that space. And for us, we were able to develop some strong systems that helped simplify that. With my tech background, I was able to automate a lot of things and scale a lot of things better than some of the older property managers. And I think that type of displacement is attractive to people.
Yeah, definitely makes sense. So we didn't touch on it, but did you end up leaving your full-time job and now you just do this completely? When did that
Yeah,
happen?
yeah. I left my job in 2018, um, so it's been about 2 years. And that's why we've started really doubling down on the 40 doors that I've added. I had never pitched property management to anyone. They were either investors or they were people that followed me and saw the returns that we were getting and asked us to manage it. But before that, we haven't really marketed too much to other investors. And like I said, we just started marketing, I guess like 2 weeks ago. No, sorry, 2 months ago, and we're adding a 75 unit already. So, um, I that's kind of my focus is on growing that side of the business, and it's I had to move back, get things settled, figure out what was going on in the business, figure out what the business needed, and then help scale and grow it. And so, we just rebranded and are in the process of really pushing that.
All right, cool. So what's our last little section kind of that we like to get to is um what is your favorite resource for learning about real estate? It's like mentorship, bigger pockets, podcasts, books. Like if you had to pick one for somebody new, what would you tell them to kind of like focus on to learn the most?
Yeah, I mean, I think everyone that I know that's in real estate for the long term has read Rich Dad Poor Dad.
Hmm.
So I think that's a good starting spot. Um, and then I think Bigger Pockets is really a very strong resource. I know before I bought my first deal, I'd listened to, I think at the time there were 150 episodes, every single one.
Hmm.
Um, just go for walks or whatever, put it on 1.5, 2x speed. And what's great about Bigger Pockets is that you talk to a lot of people that are coming at it from all different angles, all different levels of, let me take a drink here,
Yeah.
all different levels of participation and engagement.
Hmm.
And so it gives you a lot of confidence because you're like, oh, I'm a little like this person, I'm a little like that person. And you start seeing how people have applied their backgrounds and skills to be successful in real estate. And so that was extremely helpful for me, the podcast. And then, I never went out and was like, that's kind of the worst question you can get as an investor is like someone emailing you and saying, hey, teach me everything you know about real estate, or hey, mentor me.
Hmm.
Um, the way that you develop relationships is, there's a guy that I'm friends with. He owns about 3,000 doors in Houston. And the way I developed a relationship with him is I'd call him with a question that actually I couldn't find the answer to online. I was like, hey, how do you think about this? And then he's like, oh, I think about it like this, and this. Then I would take action on his advice or his recommendation, and then I would give him feedback on the results. And then he would be like, oh, this guy actually, is willing to work and understands, kind of the business, and then people will invest more and more in you.
Hmm.
And that's how I've been able to develop a lot of strong relationships within the community, is just showing that I'm willing to help and provide value. Another thing new people can do is say, hey, I saw you buy houses in Channelview or whatever. I did an analysis. Here's like the best 3 houses that I found in Channelview on the MLS. What do you think of those? Here's my thought process, blah, blah, blah. Like when I was getting started, and I was on the Bigger Pockets podcast, I think in 2016. So I just finished my 6-unit purchase, and a lot of people were reaching out to me, and I asked, people to do a little bit of work or whatever and try to help me out. I think out of like 104 people that messaged me, I think maybe 2 people got back to me, and one of the guys ended up running our property management business for a year and a half. So it's just about doing a little bit of work to try to develop those relationships, and it's going to get you a lot further than trying to go on your own.
Yeah, no, that's good information. So what about a favorite piece of technology or software that you use, whether it's in your management business or your like acquisition side of the company, that just makes life easier? Or it could be personal too, whatever.
Yeah, I mean, I think if you're managing your own properties, and I recommend everyone at least uh, do a little bit of everything if they're buying their first property. And the reason for that is develop a level of discernment around skill.
Mm-hmm.
So if I would have never managed my own properties, I wouldn't have realized that I was good at it, right? I would have just like been like, oh, I got to hire someone. But because I did it, and the software I recommend is Buildium if you're managing yourself. Because I did it and set it all up and stuff, I was like, oh, there's a lot of technology components to this. There's a lot of, vacancy, you're using APIs and stuff.
Mm-hmm.
Now it's all kind of automated now, but I understood what was happening. And so because of that, it gave me an advantage. So I really like that software a lot. We'll use Asana as well, which is a project management software, similar to Basecamp, but has a little bit more features. And we'll use that to kind of track our business and track our task. So if you have repeating tasks every month to follow up on rent or what have you, then you can kind of set up those tasks. And starting small and developing those systems, if I'm 10 to 15% off and I lose money on a $50,000 house, I'm going to lose $5,000. If I lose 10 to 15% on a $3 million deal, then I'm losing hundreds of thousands. So make those mistakes on your own on smaller deals, um, or offer so much value to someone that's doing the type of deals you want to do that they bring you in on the deal as well. Those are the 2 ways I recommend folks getting started. I've always been a guy that I don't want to take money from someone until I'm confident that I can have success and have a
Mm-hmm.
success case to show. And it's not because I don't think I can do it. It's more around the idea that, um, I see myself as a fiduciary. I'm protecting people's investment and people's money. And so I need to be very confident that I can execute on my plan.
Okay. Yeah, no, that makes a ton of sense. So where can people find out more about you and Stagecoach Equity or your property management, anything you're doing?
Yeah. Stagecoach Equity and Stagecoach Management, both of those URLs work. Um, they can check out our website. We just relaunched our website, I think, 2 weeks ago. Um, and yeah, did a whole new logo redevelopment stuff starting in around December, January timeframe. Um, so find out more about me there. I'm on Bigger Pockets. They can email me, Kevin at Stagecoach Equity or Kevin at Stagecoach Management. .com, and yeah, I'll get back to them and help them in any way that I can.
Right on. Well, Kevin, I appreciate that. Hopefully some people reach out to you if they're interested in the Houston area or, want to bring some value to you or have you help them with some of their properties. So I appreciate you being here, Kevin. It was a lot of fun, and hopefully I'll keep in touch and talk to you again soon.
All right, thanks, man.
Yep.